Hey everyone, this is Ben. I publish the All in the Reflexes Substack. I usually put that out every 1 to 2 weeks, and you can find me there, or I'll post a chart or two, usually each day at some point during the day on X. So if you're interested in more real-time updates from me, you can find me there. Otherwise, the Substack. So wanted to go through a few charts and share some of what I'm seeing this week. I know it's been pretty choppy, so I thought it might be helpful to do something a bit more hands-on, and I haven't done a video in a little while. So today is Wednesday, March 4th. We know that we had the conflict between the U.S., Israel, and Iran start on Saturday the 28th, and we've had kind of a choppy time in the market since then. So we'll walk through and see if we have some tools at our disposal to try to make an assessment. So just a reminder, nothing that I share here is should be construed as financial advice. There aren't any trade ideas that'll be shared that are specific to anybody's needs or portfolio. Everything that I share here is strictly educational and a record of my kind of evolving perspective on the market. So in my last Substack update, I started doing this calendar where we keep track of the catalysts that are coming up. I know it takes some open-mindedness to incorporate the astrological tools that we see. These tie into cycles. I'm very big on cycle work, but then we see seasonal history and catalyst dates and economic data. They kind of all flow together, and when we see a confluence of a bunch of these dates, that's usually a good sign that we'll see a pivot or some volatility. And so we knew that last week was interesting because we had NVIDIA earnings. The historical monthly low for the S&P would typically fall around the last day of the month. And then we had some of the dates of interest that were popping up using the Gann timeline tools, and then our astrological events. So all of those things led into not saying that this would have predicted when we would see a geopolitical event, but they just kind of happen around the same time as a confluence of some of these dates. So we had the NVIDIA earnings. NVIDIA killed it. It did very well. I didn't get a very bullish response for NVIDIA or the broader market, and that was probably our first warning sign. There's some hesitation going into the weekend, and then we come out. We've got we knew that we would have potential for some challenges again this week. We have the lunar eclipse that was Tuesday morning, and we had a warning signal from one of our market timing alerts that we were paying attention to that was expected to clear today. So that was an area of interest, and we had some pivot points on the cycle analyzer. There was one for Bitcoin on Sunday. Bitcoin has had a nice bullish move since then, and there was one for gold today. So we knew that those things were on the radar. Eclipses are interesting. We typically see a change in trend after an eclipse, usually something that runs against the existing trend, or sometimes you get a bit of distortion where some of the charts and tools that we look at don't work as effectively. So we had this big confluence of things happening, and then next week's not quite as busy with these events as prior weeks. So whatever trend we come out of at the end of this week, probably continues on with follow through for the next week, but we'll see. So that's the calendar of events that we were looking at. Now we've got the geopolitical event with U.S., Israel, and Iran. This is data that was shared by the Stock Traders Almanac. I've subscribed to them for a while now, and I really like their work. They had sent a list of geopolitical events involving the U.S. and or energy shocks, and so they included some dates prior to 1957. The S&P. So this is all based on the S&P 500. And the inception of the S&P 500 is 1957. So I reworked the spreadsheet to exclude the dates that would have included timeframes where the S&P only included 90 companies instead of 500. I just prefer to keep the data relative to a 500 company index. So anyways, we've got this we've got 11 events, and we know that the outcomes are different after each of them. They're all either a different level of participation with the U.S. or a different level of energy issues. Some of these are more global, and some of them directly impacted the U.S. But if we were to go back and look through the charts, you'd see that you've got instances where, like the Cuban Missile Crisis, even though we had 3.5% drawdown in the first week and a 2 in the second week, the chart was already trending down. Like the market was pricing it in advance of the date of the start of the missile crisis. So that one was trending downward. You've got like the invasion of Iraq invading Kuwait. That one caught the market by surprise, and that started the downturn in this instance, and that's why we see so much follow through. Versus the U.S. invading Afghanistan. This is after, in the months and weeks after 9/11, and the market had already experienced a pretty severe drawdown, and so it was rebounding from that. So you don't have the pullback related to the geopolitical event within the first 2 weeks. So how much of the event the market can anticipate matters, and whether it's caught off guard completely also matters. But in general, what we can take away from this is, when we look at the outcome, it's about 50-50 within the first 2 weeks, whether the S&P is up or down, and the average outcome is just below 1%. Once we get past the get into the 1 month to 12 months away from the geopolitical event, now we've got like a trend that we can we've got a pattern here where we're up more often than not. And so this tells us that we know that the market was pricing in this most recent event. We'd already seen the market starting to move towards energy and defensive companies, and into gold and things like that. And we knew that we had this big buildup of military forces over the past few weeks. So the market was making its preparations, and then so now we're in a kind of a waiting period where we need to figure out, the market's going to try to figure out how long is this going to last, and what's the magnitude of impact from an energy shock, and when could we expect that to be resolved. So it's just kind of a vetting out process from rotational, and that probably takes 1 to 2 weeks to settle out. So the thing that I'm taking away from data like this is that patience over the first 2 weeks is what has historically been most rewarded, and I'm not, my personal preference is to not get too aggressive in the earliest days after the start of the event. So that's enough for that data. Taking a look just specifically at the chart of the S&P, and we'll just look at this from the perspective of these anchored volume weighted averages, and I'm anchoring them to major lows, big gaps up and down, and that's it. So we've got 4 of these things that tie back to the April 2025 tariff tantrum, and its recovery, right? And then we've got the harmonic ranges that I use to anticipate where the S&P will find support and resistance as it moves upward and downward, and then on the very right hand side we've got the volume profile, and so this is all of the volume of buying and selling that occurs at each price level, and so to start, let's take a look at the relationship with the anchored VWAPs. So we had the one anchored to the April 2025 low, and we've never come. We took a springboard off of it in April 21st, and then we've never revisited it. So it's still, we don't know if the market's going to come back and retrace to it. Usually these are tested more than once. And then we've got the one from the gap in May, That one was retested a couple of times. We've got a smaller gap in June, and that one has been was retested with a gap down in August. Retested that one a couple of times, and then the retrace in November of 2025 came back down to the anchored VWAP from May, perfectly wicked down to test it, and then we haven't revisited it since. Now we've got an anchored VWAP to the high on January 8th, so this is the price high, not the closing high, I believe, and so we can see that we've found resistance. We're having trouble staying above that anchored VWAP, and then we're starting to treat it as resistance. And we got this little fake out where it looks like we've gapped back over it and had an opportunity to treat it as support, and then fell back through it, right? And the price action on Monday gapped up to it and then reversed. And we've yesterday, Tuesday, we had a this candle is a hammer, and when those appear at the bottom of a price movement, that can be a sign of a reversal. But these things can fake us out a number of times. But this 3 candle pattern is typically a bullish reversal. So you've got an outside bar where the entire price range is larger than the range of the prior day. We open below it, we close below it, we've got a wick up into the lower portion of it, and then we've got this long lower lash that comes down, and that tests this anchored VWAP for that ties back to August of 2025, and then it just comes back down and tests it intraday. And so this could be bullish. We need to see a little bit more, I think, before I'd be too excited about trying to jump into a pattern like this. But if we do look back and see, you can see some in the recent history. We came down here, tested an anchored VWAP, had a long lower lash, did it with a gap down, then it gapped back up and recovered, and it takes off. So if we were to see something like this, where you've got, we could even throw it, one on here just for demonstration. You've got the anchored VWAP from the high at the end of August, and we have that failure from it, the gap down, gap up, and we're not sure if it's going to be support or resistance. We've got a candle that ranges from that anchored VWAP right into a support level, a support and resistance level, and then we start to move away from it. So this is like a pattern of behavior that we can build confidence on and start to expect that the market's going to move higher. That's the type of behavior that I like to see before getting too aggressive. Again, we've got a like a doji kind of candle down here. We gap down, open above it, close above the low from 2 days ago, and that's a bullish sign, right? So that's a good reversal. When you see these hammers appear like in the middle, that's when they're not quite as meaningful. But I don't want to dwell on it for too long. It just because we're sitting right here at this volume profile, and we've got kind of a rounded activity in this topping pattern, and several days of descending, lower highs, lower lows. So if we look at just closing price, you've got a series of lower highs. We were putting in higher lows, and then we made this lower low on Tuesday. So we want to see the market build some confidence and see the bulls step in and move us higher, and that's action that I would want to follow. So maybe it would look something like it would get up above this anchored VWAP, probably hit this resistance area, come back down to maybe the upper half of the candle from today on Wednesday, and then start to pull away. So we see this kind of stair-steppy movement that would take us up out of this activity. Ideally coming back down to test that anchored VWAP, now converting that from resistance into support, and maybe even we've got this rounded activity at the top, and so that will have the market a little bit nervous if we can create like a rounded base in recovery. That would instill a little more confidence into buyers that are coming back in and stepping in. So that's what I would look for from a candle structure and price action. If we take a look at some of our market timing indicators, so we've had, I think the last report that we put out, we said there were, 3 to 4 signals that were giving a yellow. We didn't have a red on the board in the most recent report. We had a red, 2 weeks ago. And so it's, what I'm seeing here is a couple of indicators that are, a couple of indicators in our timing signals that are cautionary, but they're not alarming. And so that's the tone I want to, the perspective I want to walk away from this session with, is that there are things that are cautionary to me, but they're not alarming to me yet. And what would alarming look like? So this is one of my most responsive timing signals. This is custom coded. It takes a comparison of multiple forms of volatility to the index put call ratio for the S&P. So there's an equity put call ratio that is an aggregation of puts and calls across all equities, and there's another one for the S&P as an index. The one for the index is used differently than puts and calls across equities. So if somebody's got a profitable position in equities and they want to hedge and protect themselves, let's say you had like a bunch of Palantir, you could buy a Palantir put if you thought the price might go down, and that would protect you. The institutions tend to buy puts for the index, and they use the index to hedge, and as opposed to hedging a bunch of individual positions, and so you'll see some disproportionate behavior. These methods are all forms of sentiment, right? So you've got multiple forms of volatility, either true range or the VIX or a synthetic VIX that I'm comparing, and those are all internal to price action, and we're comparing that to the way that institutions would hedge themselves if they perceived there to be risk in the market. And so there's 2 forms of this indicator. This one is calculated in a way that makes it faster, like a leading indicator, and when it breaks below its lower band, that's the warning signal. That's our early warning. The one below has an additional step in the math that makes it slower and more gradual, and you can get like a false positive below the lower band because these bands will pinch very, very easily. So it's the cross below the band and below 0 is the confirmation. And then in the middle, we've got 2 different trend lines. There's the follow line, which is too aggressive to use with equities, but it gives a sense for whether we're in a bullish stepping pattern or a bearish stepping pattern. This is typically used with currencies in FX, where the range of movement isn't quite as volatile as it is in equities, and that's why we're pairing it with a second line. I calculate this one conceptually based on one that Larry Williams did. I do mine a little bit differently, but it's using average true range in a multiple from current price, and we want to see a lot of distance between those 2 trend lines. We want them both to be have the bullish blue color as opposed to the bearish red color, and so when we see behavior like we did back in September and November last year, we got the early warning in September. We're still climbing up bullishly, so we're not doing anything proactive when we see this, and then we get into November, and the lower trend line never turned bullish or never turned bearish, and it was still inclining, and we recovered it. So this told us that we had some concern. We did break below 0, but it was it was a signal to me to be more cautious in new positions and my stop levels and profit taking on existing positions, but not necessarily the type of risk off signal that we got in January to March of last year. So we had again the break below the band with a little fake out where we're below the band on the confirmational indicator, We're starting to see the follow line turn red. We're starting to break below it, and then we get that break below the lower band and 0 on the conformational indicator, and we're already into our downtrend. So this is like an excellent way for me to use this indicator for to take risk off and be very proactive in protecting capital. And so that's how it's worked for us in the past, and it's just not doing that right now. We're dipping below it. They're very pinched. We had this early warning, and then it moved back into its band. We've got an early warning on the conformational, but it's back above its band, and it hasn't been below 0. So this isn't necessarily bullish, but it's telling us there's nothing to respond to yet. Moving on to the next one that's giving us a warning, we've got two types of breadth indicator. We've got the cumulative net new highs, or cumulative new highs minus new lows. So this is, accumulating them perpetually as we move forward in time, and then it's got a 50 period moving average with it. And this is just very simple. You get a crossover on the you cross below your 50 period moving average, and that's generally very bearish. You get back above it, it's generally bullish. And so we're above it. We've got a nice spread between them, a good distance between the breadth indicator and its moving average, but price is consolidating and has like a slightly downward angle to its closing price, and then that's contradicted, right? So we've got a relatively bullish perspective on breadth, and there's a lot of ways to look at breadth, and that's why it can be relatively confusing for people that don't look at it often. It's confusing for people that look at it a lot, because there's like 100 different ways to evaluate breadth. But so the longer aggregated measure still looks bullish. That's being contradicted by price. And the one that's more concerning to us down below is this is a rolling new highs minus new lows over a 10-day period. And so this is a very short-term measure as opposed to the the accumulated measure up above, and so this is noisier. That's why we use two of them at once. You've got slow and gradual moving one. This one can get some false positives like it did back here, and it can get really flat like it did in 2023, and that's when the faster moving one helps us. Right now we've got a steep bearish crossover where the 10-day rolling new highs minus new lows is retracing quite a bit, and that's happening while the New York Stock Exchange volume is going up. So typically when volume is rising on the New York Stock Exchange, the trend that you're in is continuing, and that's what we saw back here in April during the tariff tantrum. We had breadth rollover, we had the rolling breadth measure rollover, and volume was increasing. And we said back then, once this volume stops going up, then that's gives us some additional confidence that we've seen the low, and we ended up seeing price get back above its moving average to the upper half of the Bollinger Band. That NYSE volume tapered off, rolled over its moving average, and the bullish movement came when that volume was steady. So right now, what's giving us caution, we're not bearish on this yet because the longer term breadth measure is still very bullish, but the caution here is that we've got a strengthening trend in deteriorating breadth on the faster moving measure. So again, not something that we respond to, but it tells us that that there's caution, and that it would be overly aggressive to start chasing, for me anyways, to start chasing a dip at this juncture. The next one that we'll look at, this is also a breadth measure, and we have two ways to look at breadth on this chart. The middle is the advanced decline line, which is just the number of advancing stocks divided by the number of declining. And what I'm doing to this one is I'm dividing it by a 32-week moving average, and that gives it like kind of a noisier view. So if I turn this one off, this is what the advanced decline line looks like by itself, and this is its 32 period moving average. So you get something like this where it moves down below its moving average, and that's not quite an early warning to this movement that we saw back in April. So it's helpful information, but it might not warn us in time. So I'm dividing this by its 32 period moving average and applying a Bollinger Band. And when it breaks below the band, you get these downward movements. That's our warning sign. And then we get the additional warning when it breaks below the band. That tells us that we're starting to see a rotation in the market that is seeing more things decline than advance. And so right now we're not getting any breaks below that Bollinger Band, and the prevailing trend for advanced decline divided by its moving average is still resolving higher. Now we've got a second indicator on here, and this is the extreme vulnerability. And this breadth measure is taking a look at net new highs. So how many stocks made a new high, and then for the day, and that's divided by all of the equities in the New York Stock Exchange. And so what's important about this is it's counting the number of days that we've gone without seeing not net new highs, new lows. So it's taking a look at how many new lows were in the market divided by all of the stocks that are in the market, and it's counting the number of days that it's been since we saw that number be a figure below 0.5%. So an extreme low. And extreme lows and new lows tell us that there's a lot of bullish sentiment in the market, and you're not going to see them. After a big drawdown, you'll see a bunch of them in a row. It'll reset this counter pretty frequently, and this counter should reset as we make continual bullish movements up. But once we get to roughly 65 sessions, so about 3 trading months, once we get 3 months without seeing a single day where we had an extreme low and new lows, where virtually every stock made a new high. Once we've gone 3 months without that, that's a sign that the bullish sentiment has left the market for an extended period, and we've got greater risk of a large drawdown. And if we look back at historically, these appear. We've got one in right before we make the absolute low in 2022. They don't precede every drawdown, but you tend to see a buildup of consecutive days without an extreme in new lows. You've got one leading up to COVID. Not that it is a predictor of pandemics, but it tells us that the market is we were already seeing some bullish sentiment leave the market before that event, that catalyst occurred, and that led to the very steep drawdown. And you've got some back here in 2018 and 2019. Now, when we look at these ones where the market had drawn down when we had this extreme vulnerability get this high, you've got these situations where the advanced decline line is also declining. So you've got confirmation here. You've got an increasing number of days that we haven't seen an extreme in new lows, and you've got declining breadth alongside it with the advanced decline line divided by its moving average. You've got that again in 2019, and that's leading us into this more actually this is driving us through this downturn. It was still moving upward there. We'd been declining for a long time. We'd been in a decline for a long time when we hit the 65-day trigger here, and then we get to again advanced decline lines declining as the counter is rising. Now, when we look at today, again it was doing the same thing in April. We've got a gradually declining advanced decline, while we've got this accumulation of days without a significant new low. But we're not seeing that today. You've got even as we started to build this counter for consecutive days without an extreme low and new lows, back in November, we were declining. right, in the advanced decline line. But today, the advanced decline is still rising. So that gives us, a contradiction between two ways to look at breadth. And that tells us that there's still a lot of rotation taking place in the market, and that funds aren't necessarily evacuating the market. If you recall, on the calendar, we said that we had a date of interest that we were watching, and this is the 5% drawdown indicator. And so we'll go back here. We're applying this to 3 indexes. This is from Andrew Thrasher's paper on called the Canary paper, but the Canary signal, right? But I just call it the 5% drawdown. So when you make a new 52-week high, we want to see the market. We don't want the market to fall 5% from that 52-week high within the first 15 sessions of the 52-week high. So this is a pace and magnitude of a drawdown from a new high is a signal for vulnerability in the market. And when this signal is when it's signaled and then confirmed, it has preceded some of the worst outcomes in the market for the last 50 years. So I take this one very seriously. We had one, we had a 52-week high back in January for the S&P. We had 15 sessions from it, and we stayed within, we got out of that 15 session monitoring window without going 5% below the 52-week high. So that one resolved. And what that tells us is, like, not that the market can't go down. We can go down, but when we do, we should be looking for retraces to key levels of support and accumulating. So it tells us to be patient, and that patience will be rewarded. Now, if the Dow had closed below 47,700 by today, that would be an alert, and then the alert needs to be confirmed. And confirmation would be if, within 2 trading months from the alert, if we saw 2 consecutive days below the 200-day moving average, that would have told us that we're confirmed, and that's when I would start taking some very proactive risk-off measures. I tend to, if we do get the alert, I tend to take some some risk off anyways. Usually these alerts, like we had, we can turn them on actually. You get usually you get like when you get back in here in that April timeframe of 2025, we got the alert in March, and then you get the confirmation below it, but you get these bounces back in. The majority of these will give us a bounce and an opportunity to take some risk off into a lower high, and then we can wait for our buying opportunity and use other signals to find that. So that's how I use it. That's my preference. But in this case, we got all the way through the monitoring window, and we did not trigger an alert for the Dow. So that's good news. Doesn't mean that we can't go lower. Like we said, it just means that we haven't gotten the type of signal that we've seen before, very disastrous outcomes. So we've talked about some of the breadth and the warning signals that we're looking at. And now we'll go through a couple of things that speak to risk preference and sentiment in the market. The first one is a form of relative strength of risk on and risk off. So I'm taking the utility sector and the consumer staples sector, I'm adding them together, and I'm taking a relative strength by dividing them by the S&P. And then I'm subtracting the same type of measure where I'm taking the 2 risk on sectors, the technology sector and consumer discretionary, dividing those by the S&P. And so that gives us a spread of risk on and risk off price behavior. And what we see is that historically, the natural state, the primary trend for that risk on versus risk off sentiment is a continual drift downward, because your risk on sectors are growing at a pace faster than the S&P, and they're growing at a pace that is faster than the performance of utilities and staples relative to the S&P. So in the natural state of a bull market, in the primary trend, we'll expect to see this going down. The secondary trend will be periods of time where the market's risk off and develops a preference for utilities and consumer staples to protect capital, and those tend to be very sharp reversals, where the market is gradually in its primary trend drifting downwards. Then it gets nervous, and it we start buying utilities and staples. So two ways to look at that trend. We've got there's a lot of ways to use channels and bands with things that we measure. This method is a Donchian channel, which is where it simply looks back for like the most recent high over a certain number of days, and it plots that, and then it looks for the most recent low over an amount of days, and then it gives us like a midpoint. So in general, when we're bullish, this spread between risk on, risk off preference is going to be traveling alongside the lower channel and below its midpoint, and you get these crossovers. That's usually when we start to see risk off behavior. So the change from risk on to risk off doesn't always come. Sometimes it comes at the low, but it usually you start to see this behavior before a larger drawdown. Another way for us to look at how extreme the behavior is the measure at the very bottom, and this is taking the distance. It's using Bollinger Bands that are not visible on the chart, and it's calculating the distance between the risk on, risk off measure and its lower band. And so when you've got these steep movements, you've made a very extreme movement away from the lower Bollinger Band. Bollinger Bands are they form like they have tightening and bulging to them throughout their trend, whereas the Donchian is more static and gives us a better sense for what we're doing relative to highs and lows. So that's why I use the two. But so what we can see going back 10 years, we've only got like 7 times that that the distance from the lower Bollinger Band has gotten this extreme. And is that right? 7? Yeah, 1, 2, 3, 4, 5, 6. Yeah, this is the 7th. So it got pretty high, and it's rolled back over below its moving average. So this is fairly, I don't want to say bullish, but it was concerning to see it break above the descending trend line to start to take a secondary trend higher. This is a pattern of behavior that we've seen in the past that preceded some drawdowns. So it started to do that for us, but the pace of this transition from risk off to risk on has slowed a little bit, and the distance from its lower Bollinger Band is falling again. So that's that's not necessarily bullish, but it tells us that it's cautionary but not alarming, similar to what we said on the prior couple of charts. Another look at risk on and risk off sentiment. We're doing this in 3 different ways on this chart. The first is very similar to the prior. We're taking the technology plus discretionary minus staples minus utilities, and the relative strength of those risk on, risk off spreads to the S&P. So you've got the trend of the S&P with a 50-day moving average, and then we've got this measure of risk on, risk off sentiment or preference with its 50-day moving average. And what we see is that the trend in these things tends to lead the trend in the S&P. We fall below the moving average, and with this risk on, risk off preference in February of 2025, and then the S&P loses its so it fell below its moving average and made a lower high on February 4th in 2025, and then the S&P falls below its 50-day moving average on the 24th. So it gave us nearly 20 days notice that the S&P was going to start to deteriorate. And then we made the low in the S&P in early April 2025, and the risk-on preference recovers above its moving average, retests it, and then starts climbing. And it does that on April 30th, and that's very close to when the S&P broke above its moving average. So it's a slightly leading indication. And then similar type of look, we've got the VIX, and this is taking the highest value of all of the durations of VIX contracts. So you've got the regular VIX, the VIX 9-day, the 1 month, the 3-month VIX, the 6-month VIX, and the 12-month VIX. And it's taking whichever one of those values is highest and then presenting it in an inverted chart. And so this should also, similar to the risk on risk off preference above, this should follow the same type of trend pattern as the S&P. And when it doesn't, like in this case, it starts falling below its moving average. It tells us that we're starting to see more volatility as price rises. So that's again, it's cautionary, but not something that we respond to right away. We see that happening as the risk on risk off preference is starting to fall, and that tells us that we've got two areas to give us concern. And then at the very bottom, we've got two ETFs in a relative strength relationship. So we're taking the S&P high beta ETF and dividing it by the low volatility ETF. And very similar to risk on risk off preference, that is a risk on risk off preference, and that trend of movement should also mirror a bullish movement in the bullish or bearish movement in the S&P. And similar to the prior two, it's falling below its moving average. It's then failing into the moving average and making lower lows. And so we've got three forms of, three ways to look at sentiment with different instruments, and they've all fallen below their moving average and they're making lower lows. So while the market hasn't broken down and we don't see a red alert on any of our market timing indicators, this is a succession of three ways of looking at risk preference that tell us that we may not have seen an end to bearish or fearful behavior in the marketplace yet. We're getting kind of long into this video. I do have a couple more that I want to go through. So this is the relative momentum among the different asset classes. So we've got treasuries, Bitcoin, equities, gold, and commodities. I'm not showing Dixie, but Dixie is included in the formula for commodities, and it's included in the formula for treasuries. So generally what we'll see in a flow of funds through asset classes is, treasuries will make their high, and then funds will start to flow into equities, and in between there you've got much more speculative trading and investing in Bitcoin. And so if we're seeing equities go into a bullish bullish trend, we would expect to see Bitcoin make that transition before equities in most normal markets. These things can move out of order, but this is just kind of the most normal or typical flow of funds is from treasuries to speculative trading and investing into equities, and then after that you get gold and commodities. Now gold is a safe haven asset, and treasuries are a safe haven asset, and they're safe havens from different types of risks. So if the market's we're getting into like recessionary fears or market drawdown, then you start to see funds go into treasuries. If the market is fearful of rising prices and inflation, you'll start to see funds go into gold. And then when inflationary fears are confirmed, funds leave gold and they go into commodities. And so what we're seeing is a loss of that relative momentum in treasuries. It's dipped below zero today. You've got a loss of that relative momentum in gold, and it's dipped below zero for the first time since January, where it just barely dipped below, and it's the farthest below since November of 2025. So this is a strong movement for gold. And then you've got commodities with relative momentum at its highest level since the last day of January. And now, what else is noteworthy here is equities are rising from a low in relative momentum, but they're doing it in a frustrating fashion, much more gradual. Bitcoin had a steeper fall in relative momentum and kind of a steady bounce from it that started at the very beginning of the first week of February. So that's not to say that Bitcoin's about to go into an uptrend. I'm still very cautious on Bitcoin right now, but Bitcoin has had a steady movement, and if we're going to see risk on preference, we would expect for Bitcoin to do very well and then equities to follow. And alongside that, we would expect to see funds move away from the risk-averse forms of equities and in utilities and consumer staples, and back into things like financials, industrials, technology, and consumer discretionary. A couple more looks at sentiment. So this is the AAII Investor Sentiment Survey, and you've got the number of advisors surveyed that are bullish, and the number that are reporting that they're bearish. This is a good contrarian indicator when we're looking for market bottoms. So you've got the bulls divided by bears, and it's below, that ratio is below 1, which it's got to get below 1 for us to see an extreme. And the number of advisors reporting bullish sentiment has been falling steadily throughout the year. The number reporting bearish is continuing to increase. Now, it's trending lower, but it's not extreme. So if you look at like April of last year, this told us that we were, this is one way for us to know there's a lot of bears that are, a lot of advisors that are bearish, and when it's that extreme, that really happens at the lows. We're falling now, and we're falling steadily, but we're not at an extreme. So again, we're seeing something that sentiment that's telling us that participants in the market are concerned and they're fearful, but they haven't given us like a contrarian buy signal yet. A similar look is the exposure index. This is funds that are allocated into the market, where the survey responses are indicating that they're allocating funds, and so again, steadily falling from the high in December, and it falls anytime the market is falling. You're going to have this exposure index fall with it. We zoom into the 1 year, and again, we're steadily making new lows, but we're not in an extreme yet. So we haven't seen a signal on this survey that has told us that we've got a contrarian buy signal. And we don't need to get a contrarian buy signal for us to become bullish again, to see bullish evidence elsewhere. So if we look at August of 2025, it was on a steady decline, and then it increased again, and now we're bullish. So we're not contrarian when they're bullish. If the advisors are allocating funds and they're reporting themselves as bullish, that's generally bullish for the market. It's when the majority of them tell us that they're bearish that we've got an opportunity to move against them. So those are the sentiment surveys. We'll take one more look at the VIX. So these things haven't given us an extreme buy signal, but where could we see evidence of an end to bearish sentiment or fear in the market? The VIX is probably the easiest way for me to see it. It's very consistent. Right now we've got a situation where since the end of December, we're making higher highs and higher lows in the VIX. It's more frequently above a 10-period moving average, which is reflected by the red bars below. And we're not seeing exhaustion signals. So when you get 5 basis points away from the 10-period moving average, it'll put one of these blue triangles up above the VIX. These are much more exhaustive movements. Sometimes you'll get some, in a series with each other. Sometimes you just get one. But typically once you're that far above the 10-period moving average, that you've seen the high in volatility, and it'll start to roll back over. So we're not seeing that yet. some reason the channels always do this. So we've also got a Keltner channel. That's the green bands that are above and below the VIX, and a regression channel. So when we get to the top of this regression channel, that's generally fairly extreme, and you don't see breaks above it very often. We're getting very close to the top of it here. The Keltner channel is extended above it. What will confirm that we've seen a local low in the market is when this Keltner channel rolls over. And you can find these right in the community scripts. I've got a bunch that I've coded for myself. But if you go into technicals for TradingView, you've got the default Keltner channel, and I'm just using the default settings with it: 20 periods, 2-time multiplier, and I've got it set to a 10-period ATR. So you can apply one of those to the VIX and do this for yourself. When you see this upper channel roll over, 100% of the time that is confirmed the low for us in the S&P. So take a look at that real quick. So as we go back historically, you've got the Keltner channel rolls over, there's your low, and I put a green vertical line every time that we see that. It doesn't perfectly time the low, but it tells you that it's just happened. So that's been a very, very reliable signal for me to use to put risk back on, or increase my position sizes for new trades and new allocations. Another look. This is one that another way that we can look for an extreme. So let's say we were to see a very large drawdown, and we wanted to know when we were at the low. There's an indicator that Martin Pring invented called the KST, and this is a momentum indicator. It uses 4 rates of change and then smooths them, and produces a composite with a moving average. And it gives you this really smooth looking trend line or oscillator, right? That kind of moves coincidentally with the market. So it makes its highs and lows roughly at the same time. And steep movements tell us that we're moving into a strong uptrend. These very gradual divergences like we have with this uptrend, that's normal. It's a momentum indicator, and momentum indicators do this. They make very long gradual divergences until there's a change in trend, and so I've used this indicator with a few charts, but the way that we're using it here is Martin Pring has an indicator that he calls the bottom fisher, and it's taking that KST indicator, and it's applying it to all 30 stocks in the Dow, and then it does a scoring process, smooths it, and produces a moving average. And this tells us when we've seen extremes in sell-offs, and when we want to try to allocate some funds to to a low. And so my preference is generally to try to rejoin an uptrend and not try to time the bottom. But if you buy, the study that he did with this indicator is if you use this method to buy on these extreme retraces, those tend to be some of the more long-term rewarding allocations to investments that we can make over the years, and you can get a bunch of them during a drawdown. So you're not necessarily buying the bottom, but usually when you get a very low reading and it reverses, that's at least a local low and a tradable bounce. So you can either use this thing to make a really timely one-time trade, or try to allocate to positions that you want to hold for a long time. That's how I would use it. But it is a little bit noisy. So I made 2 other instances of it. You can find this his bottom fisher indicator is available on stockcharts.com. They've got that natively on their platform. It's not available on TradingView without custom coding it. You could custom code this with Gemini or ChatGPT or something, though. It's not that hard. But I also made one with the top 30 companies in the S&P, and then I made one for the top 30 cryptocurrencies by market cap. Now, crypto is obviously super volatile and speculative, but what's interesting is when we use all three of these at the same time, you know, you've got the Dow produces less signals, and they're more reliable. The S&P has a lot of tech in it, much more so than the Dow. The Dow's got industrials and safe havens within its 30 companies. So you can get, you know, some false signals on any one of these by themselves, but when they all give a signal at the same time, that seems to be very reliable. And so with the bottom fisher, I'm looking for about 12 of these companies to it's got a scoring process. It's going to take it below a negative 12, and the same with the S&P. I've got that one set to go to a level below 12 to produce a signal, and then cryptocurrency will run up and down all the time. So you've got to use a much more extreme setting with crypto, and I'm using negative 20, and the extremes on this indicator are 30 and 20, 30 and negative 30. So when we see all of them produce a signal at the same time, that's a reliable indication that we're very close to a low, or that we at least have a tradable moment to allocate to. And you've got them all the way back here in the COVID drawdown, and we had the signal produced by the bottom fisher for the Dow, and then one for the S&P. The crypto one probably doesn't, data for all 30 is probably not available going that far back, because so many of the speculative, the ones that are high market cap now have only been around for a couple of years. But that being said, so if we were to get into a situation where this is a rounded top, there's more fear in the market, something unexpected happens as an additional catalyst, and we get a big drawdown, I'll publish on my Substack or on X that I've seen a signal from all three of these at the same time, and I'll share that as broadly as I can. But to wrap up, we've walked through the catalyst dates. We've walked through some timing signals that are not alarming, but they're telling us to take caution and to be patient. And then we looked at sentiment, risk on, risk off preference told us the same thing. We looked at sentiment of participants through surveys and through the volatility index, and those told us the same story, that we've got we don't need to be alarmed, but it would be aggressive for us to try to step in to lows at this juncture. And then should we see a larger drawdown, we've got a couple of tools at our disposal that would help us to manage it. So hopefully that's helpful. If anybody has questions or some ideas that you think would be helpful for me to include in future updates, please feel free to reach out and let me know. But thanks for your time tonight, and good luck, and be careful in the market. Thanks.